If you're a high-income professional, doctor, lawyer, exec, business owner, you probably don't have time to underwrite deals, manage tenants, or fix toilets. But you still want the benefits of commercial real estate, cash flow, appreciation, tax savings, and long-term wealth. That's where passive CRE investing comes in. In this video, I'm breaking down what passive investing actually looks like in commercial real estate, and how you can do it without making it your second job. Let's start with what passive really means. It doesn't mean no work. It means you're not the operator. You're not the one sourcing the deal, negotiating the lease, or managing the asset. Instead, you're investing your capital alongside others into a vehicle, usually a syndication, a fund, or a direct NNN property, and letting pros handle the execution. Let's talk deal types. 1. Syndications. You join a group of investors in a specific deal, usually one property, one operator, one business plan. Targeted returns, defined timeline, monthly or quarterly distributions. But you're relying 100% on the operator. If they fail, your money's tied up. 2. Funds. These are pooled capital investments across multiple properties. More diversified, less risk from a single asset. Easier to scale, less volatility. But you get less control and typically longer lockup periods. 3. STNL, NNNN deals. Think Walgreens, Chick-fil-A, or Dollar General. You buy the property and the tenant pays all expenses. No management, just mailbox money. But you need to underwrite the lease very carefully, and tenant credit matters. Let's talk. Pros. Real estate creates leverage. Your dollars go further. You get depreciation and tax benefits. It's a hedge against inflation. It builds equity while you sleep, but it's not risk-free. Here are some watch-outs. Operators promising 20% plus annual returns on every deal. Funds with no transparency into property-level reporting. Syndications, where you don't know the debt terms, fees, or hold period. Vet the team, the asset, the structure. Ask, what's your track record? What's the worst deal you've done? How are you getting paid? What happens if the market turns? Remember, you don't need 10 hours a week. You need the right filter. Here's a simple 3-part rule. 1. Only invest with people you trust to manage your life savings. 2. Only in deals you fully understand. 3. Only with capital you can keep illiquid for 3 to 7 years. If you want truly hands-off investing, start with STNL and NNN deals. It's simple, tangible, and easier to underwrite. And the cash flow is often more reliable. Want my passive deal vetting checklist? Download it below. And hit subscribe for weekly content on how busy professionals are building true wealth without quitting their day jobs. Because in CRE, smart money doesn't hustle harder. It deploys smarter.